focus on more unexpected events taking place. We are seeing some extremes in terms of inequality and what we're seeing in society. And I think that those tend to be times when we see outcomes that we don't tend to expect.
I say to clients, measure us every day. 1, 3, 5, that's not the point. Those are markers to the longer term destination to make sure you're on track, like Dan talked about, to have that dialogue.
At the end of the day, my role and my function, I think, in this process is to provide for stability, to invest for stability on behalf of the participants, which I think has a compounding effect to provide stability in the community.
Hello, I'm Sarah Williamson, CEO of FCLTGlobal, and I'm here with Matt Leatherman, Head of Programs here and co-author of Balancing Act, Managing Risk Across Multiple Time Horizons. So Matt, can you tell us a little bit about what we're going to see today?
Thanks, Sarah. What we're about to see is a resource for institutional investors that are interested in focusing more on the long term through the way that they manage investment risk. That includes some how-to information, brief precedent-setting views from long-term investors, and also examples of how this work can have practical impact as investors navigate trends like climate change.
So why is all of this content important? Can you tell us that?
You know, everything that we do departs from our members' founding perspective that short-term market pressures can produce resource misallocations. This content can help long-term investors take control by balancing the pressure for short-term results, reallocating capital accordingly, and meeting the responsibilities that they have to constituents and to their stakeholders.
So there's some vital strategic issues that you have just raised there. How will this content help people navigate them?
Foremost, this is a resource for continuing professional development of staff in the investment risk team. Also, institutions, executives, and trustee directors govern how risk and return come together, and this content can help them start those conversations. Additionally, sponsors and clients need points of comparison, and they may appreciate getting the perspective of peers from this video.
Great, thanks, Matt. So on behalf of FCLTGlobal, we really hope that everyone watching enjoys and benefits from the material that you're about to see.
Today's risk professional is vital to an organization's ability to focus on the long term. Their insights set the reference frame for their organization's long-term investment strategy, without which investors would be flying blind.
I think the risk manager actually plays a really critical role in being able to define the metrics by which we measure these kinds of activities. So one case in point, when we think about different horizons, there are a number of different measures of risk over those horizons, and not all measures are created equal. You know, the typical volatility that we use, volatility over longer horizons is very hard to measure, and there are other metrics that you could use, tail probabilities, or in the cases of binary risk, probability of success or failure, that you can use in concert with the typical measures. And when you start using different metrics, you notice that behavior changes in response to those new measures. Framing is actually key in terms of making good decisions. And a number of behavioral economists have documented that when you change the frame, you can change completely the outcomes because people's preferences are highly dependent on the context in which they're being presented. So I think we really have to be very careful in terms of managing that type of framing, and hopefully developing a consistent methodology for doing that would actually lead to more consistent investment decisions over time. The example that I like to point to is the typical time horizon that it takes to develop an anti-cancer drug. Typically, we're talking about the space of anywhere from 5 to 15 years. And that's really the minimum time before you reach a proof of concept in that particular space. So if you think about making an investment in biomedicine, over the course of the first, 3 to 5 years, you can expect 0 return. And so if your time horizon is limited to that short window, you're going to basically lose all your money because you're not going to get anything back in that very, very narrow time slice. Unless you start thinking about time horizons much more directly and attuned to the particular investment opportunity, you're actually going to be in a really serious disadvantage compared to other longer-term investors.
As a risk expert, you have special tools to increase focus on the long term, knowing that what you choose will affect outcomes for years, even generations.
The way that we calculate risk, the textbook ways of calculating risk, are inherently end of horizon in nature. So if we're calculating a 1-year value at risk or a 1-year probability of loss, what that equation is telling us is the likelihood of experiencing that loss at the end of the horizon. Or if it's a value at risk, it's telling us what's the most we could lose with a certain probability at the end of the horizon. It's not telling us what could happen along the way. And what can happen along the way is extremely important, because if we're not ready for it, if we're not prepared, if we don't understand it, it could lead us to, at a minimum, have some very difficult discussions with stakeholders. But on the other end of the spectrum, we could actually be forced to deviate from a course that was actually the right course, just because we didn't understand the kind of loss that we might have suffered. So we think this notion of within horizon value at risk is very important. What we're implicitly assuming is that returns are independently distributed, so that returns at each period are not related to returns from the last period. In fact, in many cases, that is not true. And as a result, the extrapolated estimate of what risk would look like at an annual horizon can diverge from what it actually looks like on an annual horizon because of that lack of independence. We haven't discovered anything here that nobody understood. There's no new math. It's really just highlighting a common assumption that we all make that's hard-coded that we should take a fresh look at and just think a little bit more carefully about. So it's an easy remedy.
Let's apply some of these concepts. Now would be a good time to pause the video and interact with teammates in your group. If you are able to access or sketch them, scenario or simulation exercises are especially impactful at moments like these. Washington State Investment Board offers a perspective on how long-term focus can put short-term risk in context.
We live in an environment where everything is being blown up when something happens. And by that I mean it gets a lot of publicity. While it feels like a main event, over the long term, it could have very little effect on the overall performance of our portfolio as it kind of evens out. So I think we always keep a 15-year return perspective front and center.
When long-term asset owners invest through external managers, they structure the risk provisions of their mandates to preserve this focus.
When somebody says, how much risk do you want to take, an investor, the first question you have to ask back is, how much time do you have? If I don't get those two right, then I can't understand the amount of risk that I need to take on your behalf.
Is an onus on an asset owner and their advisors to really understand the investment manager's process, how they manage money, what their value creation philosophy is. And I think if that is being done properly, then to a certain extent, you're holding them accountable for managing the money the way in which they said they would manage the money, rather than for the short-term consequences of that. You have a longer term. Now, of course, that doesn't mean you just give them a pass for several years. You're going to have reviews with them on a regular basis. But what you're really seeking to do is to understand what they've been doing and whether that is in accordance with the way you understand them to manage money. You will build a portfolio in a different way if you are trying to maintain some kind of measure of benchmark relative volatility, so that people worry that it'll scare the horses if your portfolio falls more than the market, or substantially more than the market. Whereas, the reality is if you're looking at the 200-year return or even a 10 to 20-year return, that short-term volatility really may be immaterial.
When we started to have this different dialogue with the board by talking about full market cycles and starting to talk about having a longer term view, they got very interested in terms of the whole dialogue. And what they came back to us and said, well, yes, we all talk about long term, but maybe we are a bit disconnected in what our view is versus yours. And so they asked us explicitly, tell us how you're really managing the teams inside, how you're compensating people to think long term, what metrics do you use, how are you looking at attribution? And through this whole conversation, it took about 2.5 years. And when we sort of just laid it out to them versus the board reporting that they would get, where your 3-year number is highlighted and year to date 1, 3, 5 was sort of the focus of the conversations, they actually stepped right into it and took an initiative to say, we want actually all the board reporting to change. We need you to change it.
Not only do you add to your organization's long-term focus, you also preserve it when markets are difficult by limiting surprises and controlling panic.
The main way that a long horizon lowers risk is that it certainly lowers the chance of loss. So if you want to, if you invest in a portfolio or a risky gamble, even like a coin flip, that has a positive expected return, the more times you play and the more patient you are, the more likely it is, probability-wise, that you'll end up with a gain. Time does not remove risk, it just changes it, right? It reduces the likelihood, but it increases the tail and the severity. And so it's not removing the risk, it's changing it. And I think that means what we need to focus on is studying the long-term risk. We can't just assume it isn't there. And in fact, we have to study it more because it's different. The chance that your portfolio is down 10% at some point is of course always larger than the chance that it's down 10% at the end.
Yep.
It's that plus sum.
Yep.
And the plus sum is quite big.
Right.
Than the risk that you had just at the end. That's the first point. I guess the second point is that the longer the horizon, the larger the chance that you suffer a certain drawdown, a particular size of drawdown.
Yeah.
The more time you play, the more possible it is to get an unlucky streak.
Now let's hear from CPP Investments, an organization that acts on these insights.
In quantifying our investment risk appetite, we move beyond shorter term or traditional measures of risk. If our sole focus was on mitigating shorter term market volatility, we would likely compromise our longer term objectives. So as a result, we established a longer term series of risk measures.
We can't presume everything will go as planned. In fact, we have to assume that periods of disruption will arise and that people will react differently. Focus hinges on whether the team is prepared for the lows or if they come as a surprise. Seasoned travelers know to expect turbulence and are able to keep calm through the end of the journey.
The fraction of the variability of returns that is being driven by just the first few factors. Right. We call this the absorption ratio, right? So the idea is that if just a small number of factors is driving a large fraction of the variability of returns, that means that the markets are very compact, very tightly coupled. Right. And when the markets are in that state, they're very fragile because shocks travel, quickly and broadly when everything is tightly coupled. So, and then if you think of the converse, if it takes a lot of factors to explain the variability of returns. What that tells us is that risk is diffused across many independent sources. And when, that's the state of the markets, they're much more resilient to shocks. So this measure, which we term the absorption ratio, you know, how much of risk is being absorbed by these few factors, is a very good indication of a market's fragility. And you know, one of the experiments we did is we looked at all of the major sell-offs in our sample, 1 day sell-offs, 1 month sell-offs, 1 year sell-offs, and we calculated what fraction of those downturns were preceded by a spike in the absorption ratio. And what we found is that almost all of them were. But you have to be careful in how you interpret that. So just because most sell-offs are preceded by a spike in the absorption ratio, it doesn't mean that most spikes are followed by a sell-off. Because what this is capturing is vulnerability to a sell-off, right? To actually have a sell-off, you need two things. You need for the market to be vulnerable, and by that I mean tightly coupled, and then you need some bad news. What Markowitz did was just genius at the time, you know, 1952. And that's really withstood the test of time. But we don't have to do it that way anymore because we don't have to rely on statistical summaries. We have the computational power to deal with, you know, much more nuanced features of the data, and also, probably more important, more realistic descriptions of our preferences. So Markowitz, you know, mean variance, you can only describe your preferences in terms of mean and variance. And most investors care about thresholds, right? If you breach a particular threshold, you know, circumstances for you change qualitatively. And, you know, mean variance can't deal with that. You know, so, but these, you know, we now have the tools to do that. And so I think we just have to we know how we think about things intuitively. We have way more computational power and way more data than we used to have. We just have to figure out, now that we're not forced to use these statistical shortcuts, we have to figure out how to match our scientific methods with what we know intuitively.
Following through on the beliefs and strategy that we have chosen often is even more difficult than making the choices. Please pause the video again to interact with your teammates and experiment with scenario or simulation exercises. And now a view from Neuberger Berman.
For our asset owners, I think it is vital to understand what exactly they're getting into with asset managers. So they understand when the strategy is likely to do particularly well and what are environments that are more difficult for strategy. And that makes it easier for them to determine how it works with their overall book and also remain confident in their strategies when a strategy hits the proverbial roadblock, which eventually happens to most active strategies, but just could be a result of the market environment it's operating in at the time.
Disruption will happen. Climate trends are a timely example of this. Having a plan, strong leadership, and focused relationships can help investors find long-term success.
Climate change obviously is all three: a risk, uncertainty, and a trend, right? And physical impacts to us are a risk, right? And I'm going to be very technical here. You know, the potential outcomes and their likelihood, you know, is something that can be known. And this is based on science. And this is also based on the work that we have been doing with Woodwell and Wellington.
Much like real estate, we found in climate that location is really the key. And if you start with location, that brings you closer to the company level and further away from macro, top down, this one risk factor solves all. Every company's different, every location is different, even in the same country, like in the US and China and India, you have massive different climates across the same country. So company level has been much more insightful for us than macro level. I would say if you were trying to think about risk factors, they should revolve around location and duration. Location and duration. Again, fixed locations have the most risk and the longest maturity has the most risk.
It has to be toned from the top. Our own organization that they say, look, you have to look at climate risk. This is the subject going forward, and it will impact investment returns. Having that armed with that kind of mission, I think we go out and assess our managers and see whether they take climate risk seriously in their portfolio. Their boards, their management, are they singing the same tune?
Crises are disruptive, and it may be that the climate crisis forces the changes to investment risk management needed to focus more on the long term. Please pause now to interact with your teammates on this possibility and, if possible, engage with a scenario or a simulation. Now we'll hear from Future Fund.
The Future Fund is Australia's sovereign wealth fund. We were established to invest for the benefit of future generations of Australians. So clearly we've got a long-term objective. And as we were set up, we were given a lot of independence and latitude to pursue that objective. Now, the extent to which we lose trust or credibility with our stakeholders, the extent to which our reputation is damaged, that can really have an impact on how we approach that task. Protecting our reputation, making sure that we understand the expectations and the experiences and perceptions of our stakeholders is really important. It allows us to stay focused on the long term. It allows us to avoid getting distracted by short-term objectives or distractions, but it also allows us to maintain that latitude to pursue more complex or less familiar strategies that are a really important part of delivering strong long-term risk-adjusted returns.
Several defaults heavily influence how risk experts come into the profession, including education in the FRM certificate program and reporting in the GIPS model. Staff with these default frames of mind are ready to begin training on how to do their work in a way that specifically focuses on the long term. Importantly, long-term investment organizations have to provide that training and experience rather than taking it for granted.
A default is one way to look at it is it's a set of assumptions that underlie decision making that tend not to be on the table when you're having a conversation about what to do. So the word sort of says it all. If you set a default, you then tend to take it out of the conversation.
We require monthly returns to be used as the basis for all of the information that is being generated. Now, are we going to require a whole different set of returns for the comparable risk measures that we're asking for? And again, we only are looking for a volatility, the annualized 3-year standard deviation, as the standard required risk measure. For Sharpe, information ratio, tracking error, maximum drawdown, whatever, that would be presented as additional information and disclosed how it is done. So the only one we are actually putting constraint around is that 3-year annualized standard deviation that use monthly return. I absolutely agree that if you use quarterly, if you use annual for the same time period but a different frequency, you will end up with different numbers, which is why we said it must be monthly. You had to pick something. Annual's not going to work. Quarterly, 12, not going to work if you're going to hope to get a measure in there for 3 years. So this is how it ends up being a sort of pragmatic approach.
The FRM certifies that somebody kind of understands the broad range of risks and risk management tools. But in order to do what Jacques does, you've got to have a lot of experience as well. So I would say the FRM is the first step down the road to being able to organize the conversation, the big conversation I was just talking about.
Our final applied exercise is about how to bring your organization's purpose to bear in risk management. Again, this is a moment to pause the video, interact with your teammates, and if possible, engage with a scenario or simulation. The work of investment risk professionals affects all of us in important ways. Income levels and the way that this income is distributed is one example. As we conclude, we hope to leave you with this sense of influence and responsibility. Focusing capital on the long term depends on how investment risk professionals do this work.
Household incomes have grown much riskier over the last 4 decades. And because that has happened during a period of declining overall macroeconomic volatility, not only are households bearing more risk, they're bearing a larger share of total risk that's prevalent in the economy.
We've seen this tremendous trend of lowering of expected return and reducing volatility in most institutional portfolios to try to create some level of predictability, whether it be matching duration to your liability, matching cash flows to your required payments to participants, thinking about funding levels from a PBGC or an actuarial point of view to remain healthy enough so that you don't have to contribute more assets. But if you think about all of those conversations around institutional risk, what happens and what gets lost is, okay, how does this impact the person that is looking forward to a check for now and in for the rest of their lives or their family life?
We might now be at the point where we have to think whether the shift towards more fiscal policy away from monetary policy actually means something for what that equilibrium interest rate looks like, what our underlying assumption about inflation looks like. These are things that I think a lot of people have not had to think about for a very long period of time because they have been trending, really trending one way.
Long-term risk professionals communicate proactively and deliberately with directors.
What I always try to think about is, you know, at what level do you jeopardize, what level of risk do you jeopardize your mission, and try not to cross that line, but push your mission without jeopardizing your mission.
We need to fundamentally spend time with our clients asking the higher end questions of what is your investment objective? Because you can really only, estimate risk. The risk is the probability of not achieving your objective. Let's get clarity about what the objective actually is.
Know thyself. I think that knowing your own limits, knowing how much pain you can withstand, knowing what your pain points are, and understanding that we are all human and we will therefore react to pain in a very predictable way, I think that's the beginning of being able to build long-term wealth for your investors, because you really have to acknowledge that while we are all rational some of the time, we are almost always irrational during these extreme moments of distress, and they will occur.